Thank you, Alex, and good afternoon. It's a pleasure to be with you again. Well, last year we predicted that reinsurance pricing would continue to move generally downwards after Monte Carlo, barring no meaningful loss experience. And well, there were no major losses after Monte Carlo, and consequently cat prices were down on average 7.5% at the 1st of January 2011. Well, how times have changed since then. The first half of 2011 has been dominated by natural catastrophes in the Asia-Pacific region and in the United States, and the rates at mid-year showed it. Our proprietary index shows catastrophe rates online up incrementally by 5 to 10% year on year to July the 1st this year, and you can see the uptick in the chart here. Insured losses estimated at something like $70 billion US for the first half of the year. And again, this chart shows the major catastrophes that have affected the industry since the beginning of 2011. I'll just give you some perspective on this. The losses for the first half of 2011 are more than 5 times the first half annual average for the last 10 years. They exceed the combined total of cat losses for 2009 and 2010, and for every recorded full year except 2005, which was, of course, the year of Hurricane Katrina. Now, had Hurricane Irene lived up to some of the more pessimistic expectations, this year's losses would have been even worse. But let's not forget that there's still plenty of hurricane season left for 2011. Now, what has this meant for reinsurers? Unsurprisingly, earnings have been hit very hard. The companies in the Carpenter Reinsurance composite reported a combined loss the first half of this year of $636 million US. That compares with net income profit of $8.4 billion for the corresponding period in 2010. And at the underwriting level, the loss of $486 million last year starts to look like a rounding error when you consider the $10 billion underwriting hole that has opened up in the first half of 2011. The combined ratio shot up. It was 100.3% first 6 months last year, 117.3% this year. And severe as that underwriting loss, it would have been much deeper had it not been for the support from releases from prior year loss reserves. And in light of this, it's actually not surprising to discover that for this group of companies, the return on equity for the first 6 months of 2011 was minus 0.8%, minus 80 basis points, compared with 10.1% last year. Now, those heavy underwriting losses and so forth have flowed through to balance sheets, but actually the effect has not been as severe as might have been expected given the size of the cat losses. Now, as this chart shows, the aggregate dedicated capital, reinsurance capital for the Carpenter Reinsurance composite decreased by just 1.8% in the first 6 months of this year, and the sum we're showing there is $168 million, despite that disappearance of earnings. But if you look carefully, you will see that there was a 74% decrease in share buybacks compared with last year, and a 13% decrease in dividends paid back to shareholders in the first half of the year. Nevertheless, Carpenter believes that despite a difficult start to this year, the reinsurance market remains adequately capitalized and liquid with meaningful excess capital. This year's earthquakes have given particular pause for thought. Earthquakes have a lingering effect on claims, and this chart shows how slowly earthquakes burn, or how the losses develop, compared with hurricanes. It compares the development of the US organization PCS, market loss estimates, for most of the recent large hurricanes to hit the United States with the 1994 Northridge, California earthquake. It's about the only earthquake for which such data are available. See how the Northridge estimate in this chart took twice as long to develop, and that the development was, in percentage terms, from a much lower opening estimate. So if you look at Northridge earthquake, it took 600 days to get to the ultimate PCS estimate, and the opening estimate was only 20% of the final market loss estimate. Now, we've looked at the results of companies, public companies, this year, and for those that disclosed their cat losses in the first quarter and then disclosed the development of those cat losses in the second quarter this year, we discovered that there was an average increase of 6% in those first quarter cat losses in the second quarter. And the spread between companies was enormous, ranging from some where their estimates decreased by as much as 7% to others where they had to increase their estimates by 30%. And there were major surprises in this year's earthquakes. Now, the Christchurch earthquake was a 6.3 megawatt earthquake. Now, that's moderate intensity. And yet, the latest estimates stand north of $12 billion US for that. And Christchurch in New Zealand is a small provincial city with an agricultural hinterland and industry largely based on processing agricultural products. But it was the frequency of the shockwave and the duration of the shake which exceeded building specifications there and devastated the central business district. If you like, it was similar to the soprano singer who holds her note for too long, causing glasses to crack and to shatter. And the Tohoku earthquake in Japan also exceeded expectations. No models were calibrated for 9 megawatts intensity, because that was considered to be an impossible level of intensity. But that's what happened. Whilst, of course, the shortcomings concerning the modelling, the forecasting of tsunami are well documented. Now, the Christchurch and the Tohoku earthquakes tested and in some cases defeated accepted parameters. How confident can we be about earthquake loss assumptions for California, New Madrid, or Tokyo? Now, another issue to consider is the steady stream of reserve releases that have been supporting earnings in the face of a weakening market and also catastrophe losses. Guy Carpenter's analysis of the US reserving cycle over the last 30 years suggests the tide may be turning and a period of reserve shortfalls looms. Now, the flat blue line in this chart is the first year evaluation of industry losses. So after the first year, what loss pick are we going to make? And that is indexed to 1. The other lines show the annual change or revisions to those opening loss picks. So red is the 2-year evaluation, green is 3-year, and so on up to the grey line, which represents the ultimate computed loss figure after 10 years. Now, you can see there is a clear 7 to 8 year cycle of booked ultimate losses, both rising and falling. Now, where the series of lines are above the blue index line, that means that reserves are inadequate and they are being supplemented. Below the line, they're being released to the P&L. Now, within each cycle, the 2-year evaluation figure actually serves as a good proxy for the ultimate loss figure, and a sharp 2-year increase will lead to an even sharper 10-year increase and vice versa. Add potential pressures from inflation in some markets, weak investment returns, and in Europe, higher reserving charges which will be imposed by Solvency II, and our analysis suggests that the industry is about to enter a challenging cyclical phase. Now, in theory, all of these phenomena that I've just mentioned should be catalysts for price rises. But casualty burns slow, and in the shorter term, insurers may need to consider measures such as adverse development covers, stop-loss protection, and loss portfolio transfers, which Guy Carpenter is well placed to create and to execute. So where does this leave the market? Elevated catastrophe activity combined with a challenging economic environment has seen pricing pressure in some catastrophe-exposed markets as reinsurance capital growth has slowed this year. However, widespread hardening of the broader reinsurance market has not materialized to date. Our expectation, therefore, is that in the absence of a significant loss event, we expect the global market to drift, but without substantial decreases at the 2012 renewal.